Good afternoon, friends. This week, we have a really exciting discussion on private equity investing amidst COVID. With me, I'm happy to welcome Dheeraj Podar. Dheeraj is the Managing Director and Country Head, India at TA Associates. All of you are probably aware, but TA Associates is a global growth private equity firm. TA Associates has raised $24 billion in capital since its founding in 1968. They've been in India for over 10 years now. The firm leads buyouts and minority recapitalizations of profitable and fast growth companies. Dheeraj himself is on the board for BillDesk. He's on the board for Fincare Small Finance Bank, to name a few. And today he's going to help us understand the topic, private equity investing amidst COVID. Dheeraj, welcome to the discussion.
Thank you, Adil. Thanks for having me here.
So, Dheeraj, what's it been like, right? You write sizable and large ticket sizes. It's been a lockdown for 9 months. So, how has 2020 been for you and for TA Associates?
I mean, look, it's been a dramatic year, right? And I don't want to take away from the cost that we've all paid as fellow human beings through the last 1 year. It's been a tough year for most people in many ways. Thankfully, I would say, at a personal level or for the team or our extended family, which is our portfolio companies, by and large, things have gone okay. So the first reaction in March, April, May was really, we're holding our head in our hands and saying, God, I don't know where the spiral is. Where is it all going to end? How bad things are going to be? People safe? Our frontline workers in our companies going to be able to manage work and their personal lives and anxiety levels, all of it, right? I would say it's pretty amazing how people have been tenacious and got through this period of time, and with adequate safety and precaution, I would say, because by and large people have been very professional about how to deal with this. We've not had our head in our sand and said it's okay, what's happening is happening. So if I look back and was doing that in October, I think companies have really found a way around this crisis in many ways. They've not only learned how to deal with it, but frankly, some of them have done very well. So it's not a situation where I sit back and say, "Oh my God," or thankfully, it's not been as bad as I thought it would be. I think it's okay. People have just taken the problems in their stride and moved forward. I think that's true for private equity as well. I remember answering these questions: Are we still open for business? Are we going to invest in 2020 or not? We made a bunch of investments. We committed to 3 investments this year, which is close to $350 million invested at cost. So we've been open for business and we've adapted as well. We've done diligences and meetings on Zoom. Everybody's had to work virtual. Deals have got executed. We've had basic issues like not being able to stamp transaction documents during the lockdown, and people have found solutions to it. So I think the world has just learned to deal with it, and so has private equity.
Great. So good to know that things are looking good, right? Even for such a tough year as 2020. So we're now going to start with our first topic, Dheeraj. Now, as a private equity investor in India, right, what changed pre and post COVID for you?
Yeah, I think it taught us the value of what a business model can do. Um, and it's an interesting conversation we have within our partnership. We just found certain businesses, certain business models, certain industries being able to take the hit a lot better than others. And for no other reason, but that's how they're structured, that's how they're built. And we sort of said, if you have to put it all in one word, it's durability of the business, right? So we just found some businesses are more durable. And the reality is every country has its own macro. Hits do come, and you have to have a business model which is nimble enough and solid enough to be able to withstand it. The other is the balance sheet, because if you are an entrepreneur with high leverage, chances are in the first quarter of this year, you may have even lost your business, and it's happened to many corporate houses, right? Or if you have burn rate which you need to support and not enough cash in the bank, and money doesn't come for 2 quarters, what do you do? So it taught us the value of being conservative when it came to leverage or cash in the bank, and it definitely taught us the value of durable business models. Now, I know there is the third part, which is where is the opportunity? Because the world will move to being more efficient, more technology oriented. A lot of things that you believed was not okay in the past, uh, are acceptable behavior today. Having your employees work from home, work from anywhere, do Zoom meetings and still be productive is all part and parcel of what I think we've all very quickly adapted to. And that makes being able to, certain businesses being better equipped to handle the opportunity in the future. So we will obviously think about that, right? And we will probably end up directing a little bit more capital and bets in that space. But the sectors that we operate in, Adil, I think those remain pretty much our focus. So we do a lot in technology, we do a lot in financial services, payments, healthcare. All these sectors, I think, continue to be robust investment areas for us. Um, the last part I would say is we also saw the value of industry leaders because they have the resources to be able to strengthen their capability to deal with crisis situations. And frankly, you see consolidation. It may or may not be a good thing, but you end up seeing consolidation when a black swan event happens. And to that extent, if you're sitting in the part of the ecosystem which is better equipped to handle hits, as an investor, you sleep better at night. Um, it's a minor but very important point, contradiction itself. So we also learned the value of empathy, and in some ways from our entrepreneurs. They're all hard taskmasters. They drive performance, but there's a balance to be achieved when your employees are willing to go beyond call of duty, make things happen for the business. What do you do there? And I think investors also, through this period, in my view, um, for a minute sat back and said, yes, this is important. Short-term results are important, but a lot of it is not your control. How do you empathize with your investee companies on the boards and be constructive as opposed to being prescriptive or frankly painful? So a lot, I think, has changed in our behavior overall.
Right. So if I take away one word, right, I think I take away durability, saying this is
Hmm.
testing everyone's durability. And whoever comes through this and proves their durability is going to get stronger. From a company side, also, a lot has changed, Dheeraj. So I think, for example, what we've seen at Bank Bazaar is the expectation of contactless, be it from a
Hmm.
bank or a consumer. That's become the main investment, saying we need to make this the new normal. Everything has to be without contact, without paper, and that investment has doubled up post COVID. Now, I want to go to my second question. Now, in my prior interaction with you, right, over a few years, and also when I read, for example, you have a really nice interview in Forbes in 2019. TA Associates focuses on profitable and fast growth companies. Now, there's a lot of talk out there about companies that are not profitable but yet very exciting, right? Just help us understand what is your view on what makes or why is this so important to you?
Yeah, it's actually just our mandate, to be honest. It's not a philosophy. I think we do believe there is absolutely a great investment thesis in backing fast growth businesses that have not turned profitable. But for whatever it's worth, we picked a certain segment of the ecosystem where we thought we were relevant, and we want to stick to it. And I'll tell you why. On the board, when you have an investor who doesn't buy into what the path the entrepreneur wants to take or the business or the CEO wants to take, it leads to friction. And to us, these are two very different styles. Are you comfortable with cash burn or are you not? Are two different styles. And as an individual, you get trained to do one of the two. And hence, we don't like to switch between the two. Now, I've also been asked a question very often to say if the business is already profitable, why do they need an investor? Right? Our investing style is structured to address that, which is we become the source of liquidity for for earlier investors, even founders, in many of these situations where the business doesn't need cash anymore. We also back the business with fresh cash if it needs to be acquisitive and it needs to finance that, right? So we are relevant at that stage. Now, to us, that's one part which is a mandate. But then there's a second part which is probably underlying in your question. It's okay to be profitable, loss making and fast growth, provided the burn is in your control, right? Because what you don't want to do is to get hit by a pandemic, find that capital is not coming, you don't have enough cash in the bank, and your business is inherently not profitable. Then I think it really tests the survival of the business. Now, I know that there are people who do that and very successfully and they're very good at it. But conceptually, I do struggle with that. I think if a company has to be in that phase, it should be short and they should find a way out of it very quickly and get to unit economics, which are very, very profitable.
Fair enough, right? And you've seen at TA, I think over a decade of this. I think the point remains that all large, successful public companies are profitable. So the
Mm.
sooner one gets there, the better, I guess. And you're looking at fairly mature companies. Has it been, is there a lot of opportunity in terms of profitable, fast growth in India? You see going into 2021?
I think so. I mean, look, firstly, there have been many nice businesses we would have wanted to invest, but we are constrained by this criteria. Today, when I speak to the entrepreneurs there, I think they are also focused on the bottom line. And to that extent, I do believe that we will see more, especially in areas like tech and fintech. These are sectors where I think we will see a lot more. The second is, I think we are continuing to see scale up. In each sector, we're continuing to see industry leaders emerge in subsegments. And there's really no dearth per se of great businesses and opportunities from our perspective. The last 1 year has been a little unusual, where I would say people who wanted liquidity and then looked around and saw somebody like us willing to do it, gave us a fairly robust pipeline to evaluate. Some of that will dry up. Public markets are on a tear. I think people will choose between a private round and a public market or a public issue. So we'll have to deal with that. But that's part and parcel of our industry. There is some cyclicality. Sometimes there's a buying season and sometimes there isn't one.
Fair enough. I think my takeaway is, if anything, COVID has strengthened, right, your view on the market that, one needs to be profitable and growing. And people might have let that fly pre-COVID, but post-COVID, I think everyone's looking at it very, very closely. So,
Yeah.
Dheeraj, you're on the board of both a fintech and a small finance bank. Uh, um, what has 2020 been like, right? What has been the learning in 2020, and getting out of 2020 where people are talking of green shoots, right? What is your outlook for banking and fintech in specific?
Yeah. It's an interesting question. And actually, I think the devil lies in the detail. So I think there are enough trouble spots in both banking and in fintech. And yet there are very, very interesting businesses doing extremely well through that period. The crux lies down in first is the brass tacks. How do you get operations in order? What you described about using technology at your end and being contactless. FinCare, for instance, has been pretty much paperless for the last 3 years. And there are, 80% of the business is in microfinance, where you would argue that that's not how the world operates. They did that in order to enhance productivity, to enhance reach, and they felt that as a small finance bank, they need to have an asset light model and a way of scaling up, which is not similar to a large bank. Billdesk is obviously, they're the backbone of a lot of online payments in the country. They're an aggregator. And they've enabled online payments in this country for 20 years, well before many of us understood what fintech really means, right? These companies, to that extent, were, in my view, better equipped to deal with the entire 2020 anyway. But it also told them that they need to keep innovating from here, because what they had earlier, others now need to have. And so everybody is working towards being contactless. The question becomes, how do you keep raising the bar for yourself and for the industry over the next couple of years? I think the growth part is clear. It's about how people can address the market with more variable cost structures, or frankly, more efficiencies of scale, not so much about variable cost structures, and go after it, and frankly, avoid mistakes. If you speak to the CEOs of these two companies you mentioned, they will tell you that the first quarter was all about ensuring that things don't go off, that there are no screw ups. And today they are pretty much looking and saying what they need to do to tap into the opportunity that the market offers them over the next couple of years, because we've come out of it reasonably unscathed. I don't know if that answers the question that you had in
Yeah.
your mind.
Yeah. So I think partly, right? So it looks like your companies were already using technology heavily and did well in this phase. But you also talk to the entire banking industry. You have a
Mm,
pulse for what COVID has done. So for one, banking, and two, fintech, right? And I know
mm.
that you look at fintech as a sector which is going to grow in the next 5 years. Looking into 2021, give us some views or guidance on how you feel fintech and banking are going to play out.
So banking, I think, is a bit more complex and a bit more mixed, and it depends on geography, it depends on product mix, it depends on quality of management. I don't think it's going to be a clear, simple picture. I just believe that because the banking sector managed to raise as much capital as it did, and in some ways, I think the moratorium helped them because it didn't put undue stress on the entire ecosystem. The banking sector will come out okay, but who within the sector will do better will really come back to execution. I don't think everybody is going to do just as well. Fintech, I think, had fewer legacy issues. First and foremost, they were using technology, so operations were less disrupted. When it comes to if they're lending, then they don't have that bigger book. It's more retail in nature. If it's payments, they don't have any of those legacy problems. So I think fintech is far better equipped to be able to grow from here. And incrementally, capital will also think about where it needs to allocate. So if you want to put out, $500 million in the country, yes, you will go after a big bank because that's what can absorb your capital. But for a lot of private equity investors who play between, say, 50 million to 200 million, it makes a lot more sense to look at fintech because you'll get growth, you won't have legacy challenges, they're better equipped to deal with what the economy demands today. So I would say on the margin, it's a clearer plus for fintech.
Fair enough. One of the questions, or terms which go around these days is your industry a COVID beneficiary? Are
Hmm.
you saying that fintech is a COVID beneficiary? Would you go that far?
I, I dislike the term, to be honest, because yeah, I mean but yeah, I think it's more a disruption of the way of operations, right? The whole physical infrastructure, people in the offices, the high touch environment. I mean, I'll tell you this, and I am on multiple boards, and there are days when I have done board meetings over video conferences. I know it did not always go down well with the entire board as to why couldn't you travel? Because at sometimes you say, look, it's a single point agenda. It needs 1 hour of my time, and to spend the whole day traveling is not sensible. Today, people don't ask that question anymore, right? Everybody is on video, and you know that you can be effective. So I think industries who have adapted to the change are beneficiaries. I'm not sure I would think of, I mean, demand destruction is real. It's going to hurt everybody. There is clearly loss of income across the ecosystem. So any bump that you see from demand perspective, I do worry whether it sustains or it doesn't. But it's really your nimbleness in operations that I think can help you. Um, Now, I also understand the underlying part of that question, which is there are certain sectors, as I said at the beginning, where the secular tailwinds are there. Healthcare is clearly one such segment. Financial services, broadly speaking, is the second. I think technology, when I say technology, more software. but even tech services continues to see good traction and momentum. I think those sectors will continue to benefit post-COVID as well. And they're not that determined by, broad GDP growth rates. Some of them are, some of them are not.
Fair enough, fair enough. And both of us got on this call coincidentally after doing a board meeting. Now, I
Right.
understand that board meeting effectiveness is there, right? Everyone's fallen into the rhythm, and people know each other. We're carrying social capital. But you mentioned you did three investments in 2020, $350 million deployed. We're talking about large tickets. In terms of getting comfortable on an investment thesis and making that investment. Uh, is video conferencing as effective? And are you going to be using a lot more of it going into 2021?
Yeah, it's a very good question. And frankly, I still don't know the answer. And I'll tell you why. So 6 months back, I would have told you, no, I think we're going to evaluate, but we will need in-person interaction because we're so used to kicking the tires and figuring it out, right? We've not had the opportunity to do it, and we've still ended up investing. And frankly, in one of our investments, a lot of the senior management sits in the US, so uh, everything happened over video. That's just how the deal happened. But there was also historical context in some of these. We've known these companies, we've known the entrepreneurs, they were comfortable with us. I do think that when you bring an investor onto your cap table or an individual to your board, having personal comfort, understanding each other's style and thought process is important. And to that extent, that human interaction part is not easy to ignore. Uh, I am doing meetings in person. I am traveling if I need to and I can because I believe it's important. The other thing that I would say, Adil, is a lot of our investments come out of these interactions, not necessarily deal situations. But you and I met when we were not looking at a transaction, and we've got to know each other. You probably have a better sense of how I think and behave, and I do of you. That's important, right? We're not doing enough of that this year. I worry about that. So no, I don't think we. When the world normalizes a bit more, I suspect we will look for human interaction rather than do everything over video.
Fair enough. And this is a broader question for the private equity industry, right? What is the outlook in 2021, Dheeraj? Are people going to wait and watch? Do you think it's going to be a very active year? Because very clearly, the people who are durable and who built momentum are going to stand out. What is the outlook for 2021 for private equity?
Yeah, I mean, I've been bad at predicting crisis situations, so hopefully I'm not missing that. But no, I think look, the outlook is reasonably good. I think the economy will bounce back. There is a base effect anyway. But as you open up every part of the economy and vaccination happens and the world economy picks up, I do think 2021 is going to be a year of recovery and to that extent optimism. We know that the markets have run up quite a bit. I mean, they're higher than pre-COVID levels across the world, and it's probably true for most asset classes. So high valuations is a concern. Now, it's partly justified because people say, look, if the recovery is going to be so strong, then you're just discounting the growth, and it's okay. The risk remains that if growth is soft or if the economies go sideways, then you will see some correction. Now, it doesn't matter so much in my world, to be honest, because when we make a bet, we're not looking at spot prices. We're taking a 5, 7, 10-year view of what a business can deliver as opposed to am I buying it cheap? And to that extent, I do think 2021 will be fairly productive. Also, people who deferred their fundraising plans or their liquidity plans last year because of the environment are likely to be in the market next year. So I'm hopeful that transaction velocity will be high next year.
Got it. And let me ask you the mirror question for the entrepreneurs or companies listening. What advice would you give them if they're thinking of a capital raise in 2021?
Yeah, I mean, there are two things to always keep in mind, and I would say this COVID or no COVID. One is you want the right kind of investor. While capital is important, and you need capital when you need capital, so that I understand that constraint. But getting capital from the right investor, the right stage of your business is probably more important than anything else. Because if you achieve that, you will get a partner who will help you grow the business for the next, call it, 5 to 10 years, and that journey will be enjoyable. And if you end up with a disconnect in expectations and what you want to do, then there's too much negativity and too much negative energy that one needs to battle along the way, and it's just not worth it, right? So sitting back and thinking, what's the stage of your business? What kind of investor do you want? What kind of individual do you want on your board? Is probably the single most important decision one can take. And the other is prepare long and hard to ensure that your business is in the right shape where it addresses questions people will have before they commit capital. If you think you don't have many of the answers, take time out. Uh, get the business in shape, have the answers thought through in your head. I do meet entrepreneurs who say, look, if you want me to do so and so, I can do it. I don't know. I mean, I struggle with that because if I knew how to run your business, I would be running your business. I'm an investor because I'm backing you to have a point of view on where you want to take your business. And I want to then evaluate whether I can align my thinking and be helpful in your journey, right? So, yeah, I think being thoughtful and being well prepared are the two pieces of advice I would give people.
Great advice. Last question here. The finance minister is preparing for the next budget. As a private equity venture capital industry, right? What are you guys looking for? I posted on this yesterday, where we are looking for more policy support in terms of enabling, more in terms of central KYC, more in terms of eKYC. But as a private equity and venture capital industry, what do you want?
Each of my CEOs, I'm sure, have a long list of things they would like. But I would say just stability is what we're looking at. And I'll tell you why, because the last 3 or 4 years have had a lot of disruption for one reason or the other. COVID has been one, Demon was the other, GST was third. It's been a volatile 3, 4 years. And there is a cost to be paid for changes, right? Because people have to then put energies in dealing with stuff that they didn't prepare for. I would say if we can get 3 or 4 years of policy stability, ensure that the environment is just with lower levels of tension, people can focus on doing their business and building out their business. There is, in some ways, little less regulatory intervention that would really unlock this economy. That's all we need. I think to expect the government to support is a little bit of the 80s and 90s mentality. The government's support has to be more about enabling as opposed to giving active support in any way. And I think businesses we have enough entrepreneurs and we have enough good quality management who can build great value and great businesses over a period of time. So we should enable the economy to be able to attract capital by giving it a very stable halo, as opposed to this worry that, oh, I don't know what might change tomorrow. And hence, let me build in an additional risk premium, which we could do without.
Fair enough. Okay, so we're done with the professional questions. One personal question now. I believe you have young two daughters. At a personal level, right? I have a daughter too, by the way, and she's been great stress buster through COVID. What do you advise to people personally as we finish 2020, which has been tough for everyone, I would assume, and we go into 2021? What personal advice do you have for people?
Yeah, it's funny. This is the year where I've seen my kids the most, and yet I'm not sure. I would say I've spent a lot of time with them because the problem with Zoom calls is they get scheduled pretty much through the day, through the weekends, day or night. You're always switched on. I mean, I'm hoping to at least take some time off towards the end of the year and at least force my team to do the same and recharge batteries. I don't think we've all realized how tough the year has been. It may be just at home. Frankly, we may not do anything and not go anywhere. but I'm looking forward to spending quality time with them. It's the same thing I would have told you last year, though, which is interesting.
No, but you definitely are a good boss, forcing your team to take off. I think my team, I'm sure, is listening. So everyone take off and relax when you can towards the end of this year. So Dheeraj, thank you so much. And folks, you heard it directly from the managing director and country head of India at TA Associates, a $24 billion private equity fund. I really felt I learned a lot. Dheeraj, thank you for openly sharing with us.
It's a pleasure to be always speaking to you, and it's good fun. Thank you for having me on this.
Great. And next week, we have Mr. Ramakrishnan Seshan, who's the head of retail banking and wealth management at HSBC. That's going to be a good conversation. Dheeraj, thank you for your time, and we'll be in touch. Cheers. Goodbye.
Stay safe. Thanks. Bye.